Good evening, everyone. Welcome to our Branch Out Veritas Education Community Workshops, Finance and Career Essentials for Teens Symposium. You are currently attending our second session, Investing for Beginners. I'm Caitlin Kim, a rising junior at the Bandera School, and I will be one of your hosts for tonight.
My name is Lucas Lee, a rising junior at Woodson High School, and I will be your second host for tonight. We are part of the program Branch Out. Branch Out is a nonprofit program with Veritas education leaders that was co-founded by Dr. Yuxian Wu and Mr. Richard Wang in 2015. The organization has grown from 20 student volunteers to over 100 student volunteers yearly. Our high school student mentors come from over 50 different schools across 6 states. We started out as a peer mentoring program working at the community centers, homeless shelters, and county summer credit recovery programs, and have expanded into a community outreach program to promote cross-cultural understanding by featuring community heroes, creating research articles, and organizing community workshops.
As an award-winning community engagement program, we have received endorsement from the U.S. Congress, including those from Senators Tim Kaine and Andy Kim. Our Innovator program, focused on computer science and web development, has also won the U.S. Congressional Award App Challenge. Additionally, Branch Out was honored with the Gold Star Group Volunteer Award from the Fairfax Neighborhood and Community Services Organization. As part of Branch Out's goal to promote civic engagement, community, and STEM education, we're extremely glad to have you with us for today. Before we start this panel, we'll be playing a short video celebrating Branch Out's 10th anniversary.
Branch Out is an award-winning youth leadership program founded in 2015. Branch Out has many chapters in major U.S. cities. For more than a decade, Branch Out has connected through actions. Branch Out not only promotes STEM education, but also cross-cultural understanding and civic engagement. Multiple volunteering initiatives developing social skills. Meeting Massachusetts State Auditor Diana DiZoglio at State House. Trash pickup at the National Mall in Washington, D.C. Visit to a science lab at Harvard University. Branch Out focuses on building resilience, hope, and community, one story at a time. Empowering individuals to share their journeys. Empower, inspire, grow. Every year, 200 youth participate in the program and have helped over 1,000 students in various communities.
I just want to say thank you to Branch Out for everything that you're doing to be able to help support students, helps be able to support young people in our community, especially those in underserved communities.
I want to thank Branch Out for the opportunity to be part of this special celebration. I commend the Branch Out team and your more than 170 volunteer mentors on
Branch Out and make a difference. Branch Out offers several awards, including the Presidential Volunteer Service Award, Congressional Award for Youth Leadership, Congressional Award for STEM Education, Congressional Award for Entrepreneurship and Innovation, Congressional Award for Humanity and Arts, and Congressional Award for Environmental, Social, and Governance. Scan the QR code and reach out today.
This workshop is going to be run a little differently than all of our other workshops. After this, there will be one more session. What you see on the screen in front of you is the schedule for today with the different segments and timings listed out. You are currently attending the Investing for Beginners segment of today's symposium, where we will be covering the basics of investing and how to grow your money over time. This segment will be followed up by the How to Build a Resume and Preparing for Interview session at 7 p.m. You all are welcome to attend as many or as few sessions as you like. However, we recommend you all attend both this session and the last session as well.
Our first panelist is Mr. Bharat Arivuru. Mr. Arivuru serves as the Director of Capital Markets at Pentagon Federal Credit Union, where he leads loan sales and securitization functions. With over a decade of extensive experience spanning capital markets, securitization models, CCAR/DFAST, stress testing, and portfolio valuation, he previously held key leadership and quantitative advisory roles at PwC and the International Finance Corporation. Mr. Arivuru holds a Master of Science in Finance from the George Washington University School of Business and a Master of Science in Economics from BITS Pilani, combining deep quantitative expertise with executive leadership and financial services.
Our second panelist is Dr. John Longo. Dr. Longo is a distinguished professor of professional practice in the Finance and Economics Department at Rutgers Business School and Chief Investment Officer and Portfolio Manager for Beacon Trust, a registered investment advisor with approximately $4 billion under management. At Beacon, he is part of a team that manages a series of mutual funds and separately managed accounts. He has been a member of the board of directors of Belite Bio, a biotech firm with a market capitalization of approximately $6 billion since before its IPO. Dr. Longo also spent 7 years as a visiting professor of finance at EMBA Global Asia, the joint international executive MBA program of Columbia University, London Business School, and the University of Hong Kong. He is a best-selling author of The Art of Investing, Lessons from History's Greatest Traders, published by thegreatcourses.com and Buffett's Tips, a guide to financial literacy and life.
Third panelist is Mr. James Hicks. Mr. Hicks is a certified financial planner professional with JL Hicks Financial Group, located in Tysons, Virginia. He regularly teaches classes and workshops on college funding, retirement, and estate planning. His broad knowledge his broad knowledge of insurance and investment products can give his clients the confidence they need when working with a financial planner. Mr. Hicks is a graduate from the Darden School of Business at the University of Virginia, which is also where he earned his undergraduate degree with distinction. He is a 4 Under 40 and Quality Award recipient of the National Association of Insurance and Financial Advisors, member of the Washington, D.C. Estate Planning Council, and former board member of the Falls Church City Chamber of Commerce.
On behalf of the entire Branch Out Community Workshops team, we're extremely glad to have you with us today. Making money and managing finances have always been important parts of our modern society. To start this panel, we're going to ask some general questions first. If any of our panelists have any thoughts, please feel free to unmute them and share them. First question, directed to all of our panelists, is what's the best advice you would give to someone who wants to start investing?
Not everybody at once, right? I'm Jimmy Hicks. Thanks for having me, and happy to kick it off and break the ice here. It's really simple. It's start early, and maybe it's $1, maybe it's $5, but just do something. Get in the habit. You know, we're humans, and you know it's hard to sometimes get the gears going, right? First gear is always the hardest gear, but it gets easier and easier. And so find a way to save, put it into something that's going to be interest bearing. The stock market's obviously historically going to be your best opportunity to grow your money, and stay disciplined and keep doing it. And I'll tell you just from experience, myself, we typically don't save when we're young because we think we have all the time in the world. Next thing you know, you're 30 years old and you realize life is real, and you don't necessarily have all the time in the world, and time is money, as they say, right? It's not cliche, it's true. And so if you just started now as a young person, it would make your life so much easier. Your future self will thank you because the dollars you put away now will be compounding. It'll be 10x in your 40s and 50s. And so you'll get to the goals more easily with less risk, and you'll be able to do more in your life, enjoy more of your money. So best advice is help your future self. Start as early as you can, even if it's like a cup of coffee, you know, $4 or $5 a week, whatever it is. You'll thank yourself later.
I agree with Jimmy. You know, it's important to get started early, and you don't need a lot of money. Um, Even before that, you want to have a mindset to live within your means. That is, you want to kind of spend less than you get. Now, maybe you're getting money from an allowance, maybe you're getting money from a part-time job, birthday money, holiday money. It's important to start and have the mindset that, okay, I'm in this for the long run because, you know, if you put it in the stock market, it goes up and down every day. So have the proper mindset that you're in this for the long run. In the long run, you could all do very well. And because of the value of compound interest, you probably heard it's kind of the eighth wonder of the world. Over time, your money will snowball. So starting early, having that mindset, which is hard because with social media, you see people spending money all over the place and having a luxurious lifestyle, but you don't know if they're able to afford that. So that's what I would say. One other footnote, if you hear some thunder in the background, there's a pretty bad thunderstorm here in New Jersey. Hopefully I don't get disconnected. I'll try with my phone, but thanks for having me here.
The only thing that I'll add to that is I obviously echo everything that Mr. Hicks and Dr. Longo said. As human beings, it's really hard for us to think in compounding terms. Our brains are not, you know, accustomed to that. We're always thinking, okay, if I'm saving $100 a month, okay, I'm gonna have, whatever, $1,200 a year, and then you try to think how much you'll have 10 years hence. Do a quick thing, like ask ChatGPT to just build you a compound interest table. You'll be surprised at the amount of money that'll be left 10, 15, 20 years, or by the time you're, your parents' age now. So it's really hard until you see the numbers, and then you'll realize what a magic it is.
Yeah.
Thank you so much for all of your points. And I feel that as especially being a kid, it's really hard to like save your money. You always want like the best new thing. But I really do think it's important for teenagers to start investing because, like everyone has said, if you only start with a small money with compound interest, it will eventually snowball. And I feel like starting sooner rather than later is obviously better. But I feel like once someone will be able to like see the money that they're making, it'll influence them to start saving more and spend less. And transitioning to our next question is, if a teen only has a small amount to invest, what's a realistic way to get started and learn as they go?
I
Okay.
can start with that. So it's a little bit different today in a positive way for the young people. So today it's possible to buy a fraction of one share. So one of the themes is a famous investor, Peter Lynch, invests in what you know. Maybe you have an Apple phone, maybe you wear Nike sneakers. So you can buy a fraction of a share. Now, if you don't want to get started with individual stocks, buying an index fund is a great thing to do. An index is a basket of stocks. You may have heard of the S&P 500, the Dow Jones. Vanguard is a company that charges almost nothing, 0.03%. So I would get started early, and the way most people save, all the panelists here, we get paid money, and then out of our paycheck, some of that goes into our retirement plan. So if you're doing that, you're doing the equivalent of what we call dollar cost averaging, where you're not buying at the high or at the low, you're kind of getting an average, and over long periods of time, sometimes it takes 5 to 10 years to work, the market tends to trade up. So it's okay to start small. I think all of us started small. I started investing when I was in high school, like you, and I bought stock, and I used to collect baseball cards. So the first stock I bought was a company called Topps that made the cards, and it kind of did well. And that's one reason why I kind of stuck with the business. So it's okay to get started small. That's my advice.
Yeah. That's great advice. I started investing in high school as well. My brother-in-law was a finance major, and he said, put your money in the stock market. It was 1998, and of course, I went with tech, and I had accumulated a good account balance. At that time, it was about $6,000, which in 1999 felt like a lot of money. And a lot of that was me working at Chicken Out in McLean, working Saturdays or after school. And that was going to be my study abroad money. That was kind of the idea. And I saw 75% of that just get wiped out. And I learned an important lesson, diversification. And I think, what Dr. Longo said about index funds, you kind of spread your risk out. When you got nothing to lose, you're starting out as a kid investing, not a big deal if you want to put everything into a couple concentrated positions or a couple stocks. But I think you go broader. You're disciplined, you save strategically. I think you'll do better than trying to hit home runs. I guess is what I'm saying. Just go for the index funds. I also like to think about rather than just like, what type of company to invest in. Think about what type of account registration to invest in. And what I mean by that is, the tax advantages when you're young you don't really have a lot of income. So maybe you're just working at the pool as a lifeguard or you're tutoring or whatever. Your income taxes are basically nothing. So you might want to consider a Roth IRA. As long as you have some earnings that you can report, what you do save, even if it's small, could go into something that's tax exempt that will grow forever tax free. The issue with that is you won't be able to touch it unless you use it for education after 5 years, first time home purchase up to $10,000, or obviously retirement after age 59 and a half. But if you put it into a Roth, you're more likely not to mess with it, right? Because I can tell you again from experience, investing even early, there was lots of times I dipped into the money when I know I shouldn't have. I had experience 2008. I had money in real estate, money in the stock market. I sold low. The golden rule is to buy low, not to sell low, right? So if you put into a Roth, you're probably more likely just to set it, forget it, leave it alone, and I promise you will thank yourself for that because you'll have tax-free money, for other milestones in life, like I said, like buying a home, paying for education, or obviously retirement income.
I'll just focus on the second part of the question because obviously I agree with everything the other panelists said. So I'll focus on the learning bit, right? So it's sort of skin in the game. So let's say if you do decide to, put your money in a couple of stocks, like Mr. Hicks said, you will be surprised at how much you follow news, financial news, especially related to those companies. You will know when some big executive leaves the company, when their earnings come out, maybe even go listen to their earnings call, and that's how you learn. The more time you spend on learning about the specific companies, and that's how you learn in general about the market. And it helps to have skin in the game. And um, let's say you go to Chipotle to grab, lunch with friends, understand how the company is doing, understand, again, Apple, if you buy a share of Apple, understand, how it changed over time, when the next earnings call, what is being said on a day-to-day about the company. So that's one good way to have some skin in the game and then, learn as you go.
Thank you all for your great insights on how a teen should invest. Um, I really liked your point. I really liked your point on how you should diversify your investments, especially because you want to decrease the risks when you invest, especially as a beginner. I do have a brief follow-up question, and could you briefly explain what an index fund is for those who don't like completely understand how to invest in it?
Sure. Yeah, an index fund, it can be the S&P 500, for example, the 500 largest U.S. companies. It could be an international index. It could be smaller companies like the Russell 2000. And you want to have diversification, I mean that you don't just have all your eggs in one basket, right? The cliche saying. So maybe you have a mix of the S&P 500, small cap. You have value indexes you could buy, and it doesn't necessarily have to be an index fund. It could be an ETF. That's another option that you can look at. That's very low cost. It's an exchange traded fund. That's basically where all the money's going nowadays. Trillions of dollars going into ETFs because they are low cost, but they're also tax efficient. And they trade like stocks. So the market opens at 9:30 and your ETF is way up. And you want to sell it, you can do that. You don't have to wait till the end of the day like a traditional mutual fund or index fund. So I love ETFs. You get the broad exposure. I like buying different sectors. So for example, you want to buy gold, GLD. You want to buy Bitcoin or get exposure to cryptocurrency, which I don't know if this is really the forum to talk about it, but a lot of advisors would recommend maybe having a position for crypto, right? You could put money into IBIT or one of those ETFs that are going to be tied to crypto. So I love that because you can very inexpensively get access to really any sector of the market you want, and it's going to be less risk than say just buying one individual stock.
Yeah, at the core of it is basically a lot of people coming in and pooling their money and buying 100 companies, the stocks in 100 companies instead of one company, right? And then you own whatever share you own in that fund. That's basically an index fund or an ETF. It gives you the diversification of owning a piece of 100 or 500 or 2,000 companies instead of you owning a single share. At the core of it, that's what it is.
Yeah, thank you for expanding on that, on what an index fund is and how you can invest in it. Shifting gears a little slightly, I have another question. What are the risks of investing other than losing money that beginners should know about?
Well, there's a whole school called behavioral economics or behavioral finance, and it is a little bit unsettling to see yourself losing money. You probably worked very hard to get it. So that's one thing. Um, Sometimes, even myself, I've been doing this over 25 years. You might see a company announce good earnings and the stock might go down. So it can be kind of puzzling about the short-term behavior of the market. I think all of us have sort of a advantage longer term. In the short run, you're competing against these big funds that have resources, but in the long run, you and I like to buy things on sale, right? So if you see a good company maybe having some temporary problems, well, it might be time to get in. So Microsoft's a good example. It was down about 25% at one point year to date. And all of us use MS Office, they have some other things as well. So I would say, just sort of get that mindset that it's a roller coaster, but the coaster tends to point up and you all have youth going for you. And almost over any 5 or 10 year period of time, the market tends to go up. And that gets to our point on diversification. So bonds don't give a very high rate of return, but they're generally pretty safe. So I think just being aware of what's going on, that's also something to focus on.
It's I'll add to that in just a little bit of much broader sense. It's basically you get paid for the amount of risk you take, right? So you can't, that like Dr. Longo said, you can't invest in a bond which pays 5% a year, which is, virtually guaranteed by the US government, and can't expect to be rich overnight, right? At the same time, you can't expect to invest in some meme coin and not expect the volatility that comes with it, all the jumps up and downs that go with it. So it's risk versus reward. You get paid for the amount of risk that you take.
Yeah, I was going to say the only other thing I would look at is liquidity risk. Certain things can be accessed easily, quickly, efficiently. Other things, not so much, right? So you put money into a CD, you want to pull your money out, you forfeit interest. There's certain investments like unit investment trusts. You have to basically leave it in for a set period of time. There's also capital gains. If you pull your money out of an investment or you sell it for a gain within 12 months, you're going to pay income tax, which is not going to be a big deal for you guys. Versus, after 12 months, you'll get long-term capital gains treatment, which for most Americans is going to be preferential at 15% instead of potentially higher income rates. So those are all considerations. But there's lots of solutions to every problem or every risk. There's also, I'm not going to get too into the weeds, but there's options and things that can also help hedge for the market. Probably a little bit more advanced than what we're talking about today. This is kind of a beginner's investment call, but there are all kinds of ways to manage risk, and risks are just part of life. You're never going to live a life where there's no danger or risk. It's the same thing with investing. You just, you want to know what the risks are, and you want to make a calculated decision based on sound information.
Yeah, especially with social media these days, you have to exercise a little bit of skepticism whenever you see this as, hey, this is a safe investment that will net you 20% a year. All we do is we go buy this coin, and then this coin pays you that much amount of money, and then at the end of the year, you just double your money. There's
Mhm.
no free lunch in the market, right? So
That's a great point. Be careful. There's a lot of scammers and Ponzi schemes. I
absolutely.
can't tell you how many times I've heard from clients and prospects that they've been scammed. It happens all day, every day. It's a billion-dollar industry of scammers out there.
Yeah, there's nowadays there's no friction between, you accessing your money and then you paying your peers. There's Venmo, there's Zelle, there's all kinds of stuff. There are coins, there's crypto. It's money moves hands with the speed of lightning nowadays. So especially now, you have to be really careful when, you see something that smells fishy. And if it, goes back to the saying, right? If it's too good to be true, it probably is. So we have to definitely exercise, a healthy bit of skepticism.
Thank you
Great
so
point.
much for all of your perspectives. I really liked how you said risk versus reward and like what you put in. Like there's no telling what's going to happen, especially with the market. And Also, how there can be a lot of scams online, especially with a lot of teenagers being on social media daily. There can be a lot of scams, and I just think I think that's really important of what everyone had to say. And for our next question, how will AI change the way people start investing?
To some extent, AI is a game changer. It sort of speeds up the learning curve, but it's important to keep a perspective. We're mostly talking about the stock market here. You're still owning a piece of a business. So how can it speed up the learning curve? For example, you can say, give me a summary how Warren Buffett invests, or give me some stocks that Warren Buffett has recently invested in. But all of you know, as well as I do, that AI makes mistakes. You would call it hallucination. So it's really important, as a teacher, that the students learn the fundamentals so you know when AI is making the mistake. But I think it can be a good tutor. I think it places a lot of information at your fingertips. To some extent, it levels the playing field. But once again, at the end of the day, you're buying pieces of companies and you want to keep that in mind.
Yeah, I've read this somewhere. I can't remember exactly where, but it's resonated with me a lot. It said some people will use AI to learn everything, and then some people will use AI and learn absolutely nothing, right? It depends on how you're using it. So, for example, you can't go to Claude or ChatGPT and say, which stock should I buy, right? Rather, you can say, hey, I'm thinking about buying Apple or Amazon or Microsoft or Coca-Cola. Help me understand how I should evaluate the risks in this company. Help me understand how this company has performed over time. So use AI to learn and get up the curve quickly rather than asking it for answers. So in that sense, I definitely agree that it's a game changer and it's the great equalizer. So now everybody has access to the financial reports, performance information, historical information, recommendations from analysts. All of that is readily available to you now. But use it with the intent of learning and not with the intention of a quick response or a quick guide for you to put money somewhere that you don't understand.
I think it's a good research tool. I use it all the time. I use Copilot because it's approved for me to use because of security and things. So I can't use Claude or Gemini or some of the others, but Copilot, I'll just say, hey, I'm looking for, commodity investments that have outperformed, XYZ over the last 3 years. It'll come back with research extremely quickly. So you could tell it anything. Hey, I'd love to look at kind of the companies that paid the best dividend in the S&P 500 over the last year. It'll give you that information. Now, can that information be wrong? Absolutely, but usually it sources references the source. You can go to the source to check it out. So I wouldn't make all your investment decisions based on what AI is telling you because AI is going to be inaccurate or very limited, but it should help, I think, provide data and analysis to help make you more educated, make smarter decisions. So it's a tool.
Yeah, thank you for all your insights on how AI can change the way of investing. I do have a quick follow-up question. Do you think that AI companies or companies that produce AI can give bias? So, for example, if a beginner is asking which company to invest, can they incorporate bias into AI to get them to invest in their company?
That's a great question. Yeah, is there corruption in AI? I mean, I think there's corruption in everything. Yeah, unfortunately, we're humans, and AI is a creation of humans. And so, yeah, can a human manipulate AI? I think the answer is absolutely yes. I don't know if there's checks and balances. I wish we had somebody knowledgeable on that subject, but maybe Dr. Longo or Bharat would know. But yeah, I mean, I can't see why somebody couldn't corrupt the AI.
And we are so I work for a credit union. We are thinking about this as well, right? Until now, you had a marketing department and they went and paid Google money to insert your keywords, and there was an auction and then you paid for it, and based on how much money you paid, you ended up in wherever in the sponsored link section. Now, when Google moved to AI overviews, the game is completely changed where now the you're asking for, hey, where should I get my car loan? Where should I get my mortgage? And it's giving you a set answer in the AI overview. I think that is going up something like 60%. People using AI overviews in Google is going up 60% every quarter or something ridiculous like that. So now all of a sudden people and companies are trying to get into that AI overview box, into the search box. So that's definitely a new game that everybody's playing. I've heard, and this is in all sincerity, right? We're trying to put your product out there, make sure it's visible to everybody, trying to compete for services. But I've also seen examples where you have, you know, product pages which are purely built for AI. For example, you have a shoe catalog page where you have the products, and underneath that there's just text. Oh, this shoe is great for uh people with flat feet. This shoe has a good pronation support. This is the best in the market. So they're trying to incorporate all of that language so that all of these models go scrape that text, and then that'll automatically bump up those recommendations. And that's the same case with all, like, most of the product and service offerings. So because AI, the way that these models are scraping huge amounts of information, is it's not completely understood. So some of that will happen, at least until we have had time to evaluate how these models are working. I don't see why not, but over time, I think it's going to stabilize, and good, true, competitive products will surface up.
Yeah, thank you for your thoughts on if corruption can influence the way people invest in the future. I definitely agree that there should be regulations to AI, and I hope that as AI advances, there can be checks and balances for it. Shifting gears a little bit, we're going to open up the panel for any questions for from the viewers. Feel free to type your questions in the chat, and to our panelists, feel free to answer any questions you see out loud for anyone.
I see a question here on filtering investments. So you're new, so you don't really know what your investment philosophy is, but as you get some experience, you might say, I'm a value investor if you like to buy things on sale. Or if you like to see companies small and grow quickly, you might be a growth investor. So there are screeners. You can do some free on the internet. Yahoo Finance has one. Website I like is finviz.com for financial visualization. So you can screen the thousands of stocks and get to a short list and do further research on that. A couple of pointers. I know like stocks like SpaceX, they're kind of exciting, but they don't have a long-term history. So one way to kind of invest with training wheels is invest in companies that have been around a while, let's say 10 years or more, companies that are profitable, and some companies will pay a dividend. A dividend is a piece of their earnings. So those companies tend to be on the safer side. And, you could always pair that with some more speculative things. But clearly, if companies that have been around, seen some ups and downs, that are making money, that are making enough money to pay a dividend, which, as I said, is a piece of their earnings, that's one way of sort of getting started. Speculation would be something like SpaceX without a long-term history, at least of being public. Bitcoin, which doesn't pay any cash flow, but people can see some utility in that. So I would focus more on the investment side. And, I speculate a little bit, but it's a smaller part of my portfolio.
There's a second question that I see here about what's the difference in the performance and how it works between standard LLMs open to public compared to BlackRock's Aladdin trading software. So obviously I have not seen Aladdin directly, but I've heard legendary stories about BlackRock's Aladdin. And I think it predates the current LLMs too. BlackRock had Aladdin for a while.
Oh, yeah. Yeah.
Yeah,
It's
it's
it's the premier risk management software that all the major, banks, investment companies, they pay BlackRock for it. BlackRock being the largest money manager in the world with $10 trillion in assets. There's models that BlackRock manages there where you basically are getting access to Aladdin at a low cost by using their model. But if you want to go in and use Aladdin for your own investment portfolio, you're going to have to pay a heck of a lot of money for that access.
Yeah, and they have access to proprietary data, right? So it's not like so BlackRock definitely has more proprietary data than what the regular LLMs that are open to public have. So your response, which comes out of the LLM, is basically based on the training data, and Aladdin obviously has a lot more training data when it comes to financial products compared to the other LLMs. So
And look, you got to think back to like you guys probably weren't even alive when Enron happened, but there was a lot of companies that were bullish on Enron, and it was all a facade. It was a house of cards. There's a lot of um, folks that were going out and meeting with Enron that could smell something's not right and avoided that investment and saved their investors a lot of money. There wasn't Aladdin back in those days, but there's examples of fund managers that they had boots on the ground to do the research. And one thing I know about BlackRock, not making an endorsement for them, I'm not allowed to do that. But they have people all over the world, right? They have offices everywhere that have a pulse on what's going on. And so you have kind of like first party direct research that's being used, information that's being used, versus what's just kind of public that's out there, right? So if it's public information, it's probably already built into the price of the investment, right? The information is moving in nanoseconds. You're not going to get a beat necessarily on an investment with public information. Once you found out, it's already been priced into that stock, right?
There's a question on the best time to start investing. I would say today. Now, that doesn't mean you have to put it in the stock market because the question notes the market seems kind of expensive. As I mentioned, you can do this thing called dollar cost averaging where you invest a little bit at a time. That forces you not to buy at the high. I mean, you're not going to buy at the low as well. And you can put it in like a safe treasury bill type investment. There's Jimmy mentioned ETF, which is like a fund that trades throughout the day. There's ETFs that trade treasury bills, so that's pretty safe. Um, First of all, we didn't really discuss how to open up an account. If you're under 18, you probably need your parents' permission. There's what's called a UTMA account, which is basically a brokerage account for minors. And then when you turn 18, you get control of it. And I'm also a huge fan that Jimmy mentioned the Roth IRA. The Roth IRA, you do need income. So when I was 16, I worked at McDonald's and a place like Home Depot, a different name. And if you have some income, you can put it in there, and that would be a good way to start it. But you want to start today so you can get that compound interest working for you, which is having your money snowball over time. But yeah, I do agree that we've had a really nice run in the market. I mean, we're heading for almost 3 years in a row of more than 20% returns, which is double the
Yeah.
historical average. So yeah, and you could also buy stocks that are already beaten up. They're less likely to go down as much.
Yeah. I will say this, though, the market will be higher in the future than it is now. That's the way the market's been for over 100 years. So if your time horizon isn't, the next few years, if you're truly just putting money away for your future self 10, 20, 30 years from now, I tell you, you're better off investing than not. Could we be on the precipice of a crash? Historically, market's going to be down every 4 or 5 years. Last big, I'd say, meaningful market correction was 2022. S&P was down about 19.5%. But we've been having these V-bottom recoveries, right? It's a very atypical time. I mean, there's been nothing like it in the stock market where we're down, but then we're right back, right? You had the Iran conflict, March, then April through July, market's pretty much been straight up. Last year you had the tariffs in April 2025, same thing, market went down, then right back up. COVID in 2020, March of 2020, market went down, pretty much came right back. So I would tell you, I mean, if you've got nothing to lose and you're just starting out, my bias would be discipline investing, dollar cost averaging, like Dr. Longo said. Do it as much as you can, and just don't worry. Will the market go down? Probably at some point. It always does, but it's also always going to come back. It's reverse gravity. What goes down must go up in the stock market eventually. Um, so don't worry about the short term if you're not needing the money in the short term.
Yeah, I totally agree. You guys have time on your side, right? So it's not like you're 60 years old. So if you're, further into your life and you can't really afford to take a downturn, which is when most financial advisors would recommend you to move to safer assets like bonds and stuff. But for you guys who are just starting out and have, a long life ahead of you guys, you can afford to take that possible downturn, right? And also just pick any stock or any index fund or whichever you think is that in the bubble territory or an all-time high, and look back to its history to see how many times it has hit an all-time high and then went up higher, right? So there's also that. And if you have conviction in what you want to invest in, there's no better time like now.
Question about Wall Street financial subscriptions. I kind of explained earlier, again, if it's in the Wall Street Journal or somewhere, Morningstar, you're not going to get a beat on that stock, right? There's nothing, new or special that's going to help you. I mean, I think it's maybe interesting to read and helpful for general education, but you're not going to be able to like pay a subscription to get like amazing information that nobody else has. It's going to help you, buy the stock at the perfect time. As far as I know, that doesn't exist. There's insider trading and things like that, and that's a whole nother story. And I think a different day we can talk about that. But yeah, there's nothing really that's going to give you special information. Investing on the move of the market. I mean, we're in a headline-driven stock market now. Where the president says one thing, market's down. President says another thing, market's right back up. I literally see it in the morning. Market's doing terrible. Then in the afternoon, it's doing great because of headlines, right? So we're a headline-driven stock market right now. So it's not very rational. I will tell you that a lot of times the market does the exact opposite of what we think is rational. So I think more than trying to time the market or determine, the mood, is it optimistic or pessimistic? You just want to have a strategy and you want to stick with that strategy. And you don't want to make emotional decisions, panic decisions. You certainly don't want to try to outsmart the market because to outsmart the market, you need to time it in two ways. You need to pick the perfect time to buy and then pick the perfect time to sell. The likelihood of that happening is small. So, for you guys, it's just get the money in, let it grow. When you need money for a major milestone, probably start thinking about divesting maybe a year before that milestone. Maybe it's buying a car, buying a house, paying for college, paying for a wedding, whatever. That's when you want to start thinking about selling, hopefully at a good time when the market's up, not down.
Fortunately, that is all we have time for today, but before we wrap up the session, I would like to ask all of the panelists one suggestion that they have for everyone.
I would just kind of repeat some of the things we said, that you all have time on your side and you want to have this mindset to live within your means because then you can start saving. And if you start saving, well, if you get started early and put it in stocks, over the long run, it will go up. So just having that mindset, not panicking, and viewing this as a long run game as opposed to trying to get rich quick, which probably won't happen.
I would say be disciplined in terms of learning what you want. Read 15 minutes a day. Do it every day, like non-school stuff. If you want to learn about investing, read about investing. If you want to learn about content creation or marketing or politics or history, whatever, read 15 minutes a day.
Yeah, that's great. It's great advice. I would give you advice that I wish I could have given myself when I was, in high school. Um, it it's going to be a shock when you start making money, right? And maybe some of you guys are already making pretty good money. I mean, I was mowing lawns, working at the snack bar, worked at Chicken Out, which doesn't even exist, for I think $5.50 an hour. But as soon as I started making money right out of college, like I had my first like real paycheck, my compulsion led me to spend it. And I did that for many, many years, spending everything I made because, when you're a kid, you don't have money. And then all of a sudden you have money. It's very hard to be disciplined and save. And so the more habits you can instill in yourself now, you have to like eat well. You got to exercise. There's all kinds of things we all know we need to do. I would tell you, save minimum 10%. There's a great book. It talks about, the richest man in Babylon. Maybe you've heard of it. So it's just kind of a classic finance book, but pay yourself first. That, minimum of 10%. If you're not saving 10%, basically financial failure. But ideally, you should be saving like more like 25% of your income, right? But if you're just starting out, minimum of 10%, try to get to 25%, baby step it. If you do that, honestly, you're like way ahead of everybody else because the statistics show Americans aren't very good savers. We save on average about 8%. So we're all, there's room for improvement as a country. I think financial education is something that needs to be built on, and what you guys are doing here with this group is amazing. That you're instilling, financial education early in your group here. It's awesome, and really appreciative of you giving me the opportunity to be a resource for you guys and try to save as much as you can, minimum 10%, and you really can't go wrong with that.
Thank you so much to all of our panelists for their insights today. We hope that viewers will continue to learn about how to invest in the future. Investing is now considered an essential financial skill that helps you grow if used correctly. Unwise investments can lead to losses over time, which is why the skill is so important to master. If you'd like to learn more about Branch Out and our future panelists, please check us out at www.velbranchout.org. Like us on Facebook at Veritas Education Leaders or follow our Instagram at @BranchoutVeritas.